So, so cheerful stuff today. What can I say? There isn't actually, it turns out, a Chinese curse, may you live in interesting times. That's a fake, but there ought to be, and we certainly do live in interesting times. And if you do economics, particularly if you do macroeconomics, which is certainly one of the things I've worried about over the years, these are astonishing times, scary, just nothing that I expected ever to see in my lifetime, or I think that just about any economist expected to see. And we are now seriously talking about, is this the Second Great Depression? Which I'm not going to actually answer, because the truth is we're not sure, but talk about the ways in which it's similar, the ways in which it's different, and in general, the sense in which, whether or not it's a depression, it is a return of depression economics, which is the title of a book that I wrote in a first edition 10 years ago and brought out rather quickly in a heavily revised edition, as all the things that I was worried might happen did happen. So it's many of the same issues have come back. And I think the thing that you want to understand that is not something that might be totally clear if you're not an economist, is the extent to which what's happening is not supposed to happen. I mean, not just that, we believe in markets and so on, but that specifically the kinds of problems that we're having now were problems that we thought we'd solved. It's kind of like some disease that has long been controlled has emerged in an antibiotic-resistant form, right? It's something that was not supposed to be happening. And I have kind of a roster of people saying things that they really regret having said. So this is Robert Lucas, the great macroeconomist, wrote in his presidential address to the American Economic Association. He was basically arguing the time has come to shift our focus to long-run growth because, those depression-type things, we know how to deal with them. They're not going to happen anymore. So he wishes he hadn't said that. Now, there were some people, actually, as it happens in the early years of this decade, we had a little sort of knot of people who were really worried that maybe we didn't have these things as well under control as you might think. So I was certainly worried by the example of Japan in particular. Lars Svensson, who's now on leave working back at the Riksbank in Sweden trying to save his economy, was worried about it. And there was this third guy, what's his name? Ben Bernanke. Don't know what happened to him. But somewhat uncharacteristically, maybe because it was a Milton Friedman celebration, Ben had this to say. He said, Milton Friedman and Anna Schwartz famously argued that the Federal Reserve, by failing to do what needed to be done, by failing to take strong monetary expansion, caused the Great Depression. If the Fed had done its job, it wouldn't have happened. And speaking on behalf of the Federal Reserve, our former department chairman said, "Yeah, you're right, we did it, and now that we understand this stuff, it's not going to happen again." Except, of course, it is. So that's the sad irony here. Lastly, somebody saying something really stupid, basically believing that the Federal Reserve, whoever's in charge of it, can do whatever he likes. This is me in 1997 saying, Greenspan, or it would be these days Ben Bernanke, that the unemployment rate will be what Greenspan wants it to be, plus or minus a random error reflecting the fact that he hasn't quite gone. Okay. We all came into this. Now, I actually changed my mind just about a year after that. I started to get really worried about whether you could do that. But still, what's happened, the scale of it is something that even the pessimists among us didn't expect. Let me show you a few charts. This is from the Organization for Economic Cooperation and Development, and it's a projection, though it's not too different from other people's projections. The output gap, that's the difference between potential output, which is a term of art, meaning, roughly speaking, what the economy would produce at normal, more or less full employment. The economy can sometimes run a bit hotter than that, but it's sort of an estimate of what it ought to be. And there looking right now, the United States is probably about 7 percentage points below potential already, and falling fast. Other advanced countries moving more or less in tandem. If you look at these things, the United States has had severe recessions before. We had one in the early 80s where the unemployment rate was higher at its peak than it is right now, although we're heading there. Other countries have had severe recessions, but this one is not only severe, but it's synchronized. We're all in this mess together. And so if you're looking at the world as a whole, or strictly speaking the OECD, this is just the wealthy countries, we're looking at, well, they say 40 years because that's as far back as this chart reaches. It's actually by far the worst thing since the Great Depression. This is an awesome, incredible slump that's hitting the world economy. You might say, well, it's nothing like the Great Depression, even so. Saying the worst since is not saying as bad as. Except that it turns out there's been some historical work done. This is mostly Barry Eichengreen at Berkeley and his co-author Kevin O'Rourke have gone back looked at some comparative numbers for the Great Depression and what's happening now. And if you look at the United States, what's happened so far is sort of about half a Great Depression in terms of the pace at which we've been going. But it turns out that on things like industrial production, actually in the 1930s the U.S. was the worst. This time around Japan would be the worst. So if you take a global view, this is what Eichengreen and O'Rourke show about industrial production, comparing the current slump and the Great Depression, and so far we're on track to having a slump that is as bad as the Great Depression. It's actually, we're not doing better. We're actually so far plunging just as fast. If you look at world trade, we're actually plunging faster than happened in the Great Depression. So comparisons to the Great Depression are not hyperbole. This is for real. We do look like the early stages of the Great Depression. Now, early stages. So where we are now, roughly speaking, is where the world was in the fall of 1930. And the fall of 1930 is not by any means the worst it got. What happened, what followed that is what made the Great Depression so great, you might say. What happened was that that you had the wave of bank failures in the United States, and then a corresponding wave of bank failures in Europe. And you had some really destructive policies followed by a number of countries which did things like raised interest rates in an attempt to attract gold because they were trying to cling to the gold standard. And so a lot of bad things happened in 1931 and thereafter, which have not happened yet this time. And our best hope is that they won't happen. That we have learned at least a few things from the experience of our grandfathers, and that we're not going to do the full replay. But it really is an extraordinary. It's a slump. How do I want to say this? There is a much quoted, extraordinary essay by John Maynard Keynes, an economist who's back in fashion, and he wrote an essay at the end of 1930 called "The Great Slump of 1930," which reads like a description of contemporary events. Reads just like it's about what's happening now. And in fact, the world as it is right now is about where it was when John Maynard Keynes wrote The Great Slump of 1930, but not, at least so far, what comes next. One more thing to look at, and this is one case where we're actually doing worse than our grandfathers did. Believe it or not, the disruption in our financial markets is now worse than it was at this point in the Great Depression. So this is the spread between, I assume many people know, BAA. So it's corporate bonds that are investment grade but not the highest grade, and kind of a measure of how disrupted or how much risk aversion there is in the market. But anyway, it's a simple measure of financial stress, and we're doing worse. This is, by the way, to give you a sense of just how much things have changed, this is coming from a new report from the International Monetary Fund. Now, the IMF tends to be, being an international organization and all that goes with it, almost by necessity, is bland, writes in long sentences with not many verbs in them, and just generally just doesn't say anything very striking. But even the IMF is basically saying, hey, look at this, guys, this is really pretty bad. One more thing after that, actually. One thing we worry about a little bit, people talk, did we run up too much debt? So this is a measure of their household debt as a percentage of gross domestic product. It's just sort of a simple measure of how deeply people are in debt. And, sorry, wonkish stuff. There are two lines because we don't have a consistent data series, so there's sort of a slight mapping, splicing issue. But guess what? Turns out that we ran up to levels of debt not seen since the eve of the Great Depression. So there are a lot of resemblances between what's happening to us now and what happened at the beginning of the 1930s. Okay. Now, if you'd asked, I think most economists who work in this, could anything like the 1930s happen again? They would have said that something like the shocks that happened in the 1930s, a financial crisis, could happen again. They would have said that stock market busts could happen again, because we've seen those. I mean, it's, and particularly if you'd been paying any attention outside the United States, you knew that the great Japanese financial bubble burst at the end of the 80s, and that there was that it turns out that the age of irrational exuberance followed by abrupt pessimism is not over. But what you would have said, certainly what Lucas was saying in that first thing he was, quotes things that people said that they wish they hadn't said, was that we had the tools, that we figured out, we knew what to do, and that if a depression-like scenario started up, this time we would do all the things that our grandfathers and their policymakers did not, and that we would really, act to prevent it. And to a certain extent, we are. So let's talk a little bit about what the response has been. Right now, the United States, we have an activist new administration, which certainly doesn't believe in letting markets fix themselves. We have a Federal Reserve Chairman who, despite sorrow over his demotion from department head here, is very much someone, a scholar of the Great Depression, very anxious to move. So you expect that they're going to react very aggressively. The first line of defense against a slump like this is cut interest rates. That's the thing that the Fed can do. The Fed has control over interest rates. The Fed can, not all interest rates, but has control over basically short-term government interest rates. And it can use that to try and make money cheaper, try to offset the collapse in demand. And the Fed has been very aggressive about cutting interest rates. As aggressive, actually, as it can be. And that's the problem. So this, by the way, this is actually from the third best-selling Principles of Economics textbook, Krugman and Wells, and from second edition, where we were frantically, if anybody's ever done publishing, we were making major changes in second-pass pages, trying to keep up with this damn thing. Anyway, and you see what's happened there. That for actually, I remember reading. You read stuff about the Great Depression. You read about how the interest rate on Treasury bills was 0.14%. You say, "Oh wow, those were crazy times. Nothing like that will ever happen again." And here it is. We're up against the zero bound, and right, you can't push interest rates below zero. At that point, people would do better to just hold cash. There is apparently a substantial increase in the sales of things like mattresses that also double as safes. So we actually are in that world right now. Okay. Well, that's okay. That's step one. That's the first thing you do. You do an aggressive cutting of interest rates, and we hit bottom on that quite quickly, and still the economy falls. So the next thing you do is have the federal government try to prop up spending. And so we have the stimulus. And huge, as I guess everybody knows, huge debate about the stimulus plan, fierce fighting. It was somewhat reduced in size to accommodate 3 Senate moderates whose votes were needed. Al Franken, where are you? But a lot of talk, most of the reporting talked about how enormous it was. And it's true that by historical standards it was enormous. What has struck pretty much all of us, now that we're actually faced with the necessity of trying to use government spending to prop up demand during a depression-like episode, is how hard it is to get spending, hard it is politically and actually just plain technically, to get spending on the scale that you really ought to undertake. So you can try to do your back of the envelope of how much we need, and it comes out to be truly enormous numbers. It's easy to say that the stimulus really should have been twice what it's actually been. If you actually look, so this is Congressional Budget Office projections. And it's the same concept as before. It's the difference between potential, sort of normal output for the economy that will actually produce. And the heavy line is their forecast. The lighter line is, they say, what it would have been without the Obama plan. And there's two things. One is it does say that the Obama plan makes things better. The other is not that much better, that even with the plan. And basically, one way to look at it is that the administration argues that this plan will add about 3.5 million jobs to what we would otherwise have had, which is reasonable. That's more or less what most, that's in the range. That's not an especially high estimate. But we've already lost more than 5 million jobs. Once this month's numbers are in, it'll probably turn out that we're close to 6 million, and of course the economy needs to add jobs just to keep up with the growing population. So we're probably, at this point, close to 8 million jobs down from where we should be and still falling. And 3.5 million jobs doesn't sound like quite so much at that point. It's a plan that mitigates, but it certainly doesn't produce, doesn't fully offset the shock. You might say, well, it doesn't at least produce recovery, because if you look at this thing, it shows the economy recovering over the next 5 years back to normal. And what is that forecast based on? And the answer is it's based on the congressional budget assuming that the economy will return to normal in 5 years. There's no, and that's one of the things that actually has me very worried, because there really is not, it's not all clear where this recovery comes from. Other things that have been happening. The Fed can't cut interest rates on Treasury bills below 0, but it can do other stuff. And in fact, one of the things that Ben Bernanke, before his demotion, did quite a lot of work on was talking about the other things you could do if you found yourself in this kind of situation. To a certain extent, actually, U.S. monetary policy these past year and a half has been a matter of marching down Ben Bernanke's CV. So we tried his 2002 paper, that didn't work. We tried his 2003 paper, that's not quite fair. But what they've done is the Fed has gone, this part of what was going crazy with those second pass pages, that we have a chapter on the Federal Reserve. And, it starts with simple declarations. The Federal Reserve basically holds U.S. government Treasury bills and not much else. And whoops. So we all have pictures like this. This is the Federal Reserve's assets in billions of dollars. And the blue stuff at the bottom is Treasury bills. And until not very long ago, that was everything. And now it's got all this other stuff. And if you would want to read it. So agency, that's Fannie Mae and Freddie Mac. Maiden One, believe it or not, that's Bear Stearns. MBS is mortgage-backed securities. AIG, you know what that is. And so on down the line. They've really been incredibly aggressive. They've done stuff that no one has, no central bank has ever done before, boldly gone and all that. It's probably helped some. It probably has actually mitigated. Some of these measures of stress in the financial markets have come down a bit, but nowhere back to normal. It's actually been striking that even with this extremely aggressive policy, we're not all the way there. Banks. So one of the things that has been a big bone of contention is what do you do with, when you have a crisis like this, you have troubled banks. And they're certainly part of what perpetuates the crisis, and what do you do about it. And I think the striking thing there is how hard it turns out to be to do anything really forceful about the banks. That you can get a whole bunch of quotes from senior administration officials a few months ago saying we will not do what the Japanese did and allow the banks to sort of sweep their problems under the rug and allow the thing to drift for years and years. And then what we're actually doing is letting the banks sweep the problems under the rug and allowing the thing to drift. And actually, if you talk to them now, they actually say, well, drifting might not be such a bad thing. So it's been really striking how hard it is to get this thing moving. Now, just this morning's headlines, that the banks are being subjected to a stress test. And it's been unclear what they'll do with the results of the stress test, how they'll respond. And according, at least to Bloomberg News this morning, the reason that hasn't been announced is that they themselves have no idea, and that there's infighting about what exactly to do with the stress test results. Not encouraging. All right. I actually have a lot of sympathy. This is really hard stuff, but it's turned out that's the point. It's really hard stuff. Okay. Now, there's been some increase. The stock market is up quite a lot in the last 5 weeks. There's been some optimism. And, in fact, there's been, you might say, quite a lot of surprisingly upbeat feelings about the economy. The best summary of that I've seen is from Tom Tolles the other day. The economic force has turned up based on a couple of data points. What is true is there was about 4 months when every single piece of news that came in was worse than you expected. When every time there was a new data point, a new corporate reporting story, it would be, oh my God, I was expecting bad news, but I wasn't expecting this bad. And it was a sort of open up your notebook computer in the morning and say, I didn't want to look at what was going to come up. And for the last 6 weeks or so, the news has instead been not good. Almost all the news is still about things getting worse. But generally speaking, things are not getting worse quite as fast as people expected. They're certainly not getting worse as fast as they were, well, I shouldn't say certainly, but by and large, they're not getting worse as fast as they were in the previous 6 weeks. The flow of news has turned a little less shockingly bad. It's not a case of things improving. It's a case of, at best, things getting worse more slowly. But even that's sort of positive news. And it's really, you have to be, it has to be summarized cautiously. The Fed has this thing called the Beige Book, which is a once every 6 weeks survey based on just sort of, they talk to people. And the good news in the Beige Book this time was that they said that 5 of the 12 Federal Reserve districts report that the pace of decline has moderated. So things are getting worse more slowly in part of the country. That's kind of where we are now. That's a possible sign that we are going to avoid the full Great Depression experience. On the other hand, there was kind of a pause in the collapse of the world economy in late 1930, and then all hell broke loose with the bank failures. And what we're hoping is that we have enough wisdom to avoid having that happen a second time. Even if it does stabilize, this is going to be almost certainly very prolonged and very, very nasty. There's been how do we figure these things out? A lot of what people have been doing has been looking at as many seemingly relevant experiences as possible. So one of the things that Kenneth Rogoff and Carmen Reinhardt, another couple of economists, have been looking at many financial crises and just sort of looking at the average, looking what happens. And this is, I'm sorry, that's a little, no, it's not too small to read. They give you some sense of how long and how bad things get when you have serious financial crises. Yeah, the average is about a 7 percentage point increase in the unemployment rate, which in our case would mean the unemployment rate getting up to almost 12%, which is, we're hoping that doesn't happen, but it's not wildly unreasonable right now. And the slumps often last 5 years. These are bad things. And there's one more thing to worry about, which is, if you look at these crises, how do they end? The acute phase ends eventually anyway, but how do countries actually recover? What's the route by which you actually recover? And the answer, and this goes back to the IMF, which has done a lot of this stuff, it's normally been through exports. If you actually ask, how did the East Asian economies that got caught in this terrible crisis in the late 90s, how did they bounce back? How did Japan finally emerge from its lost decade? It was through exports. The trade balance, so that's the red line, shows trade balance as a percentage of GDP. It typically rises by 3.5% of GDP. That would be the equivalent in the United States of a $550 billion rise in exports, which is, okay, that's how it usually works. But there's a problem, which is that this is a global slump. And we can't all export our way out of it unless we can find another planet to sell to. So there's some concern that this could be even deeper, even longer than the typical financial crisis. Okay, awesome stuff. The only thing to say is that it is at a fundamental level. This is a malfunction. This is not a case where the planet has run out of resources. That's some future crisis. It's not a case where we don't have the ability to recover. What we've got is a snafu, a screw-up. The economy crossed wires, or actually in that great John Maynard Keynes essay about the slump of 1930, he said we have magneto trouble, which turns out to be an old-fashioned piece of the ignition system. So basically, we've got a spark plug trouble. So the spark plugs are defective, and that's why we've stalled. And we ought to be able to fix the spark plugs and get the thing moving again. There's no fundamental reason why we shouldn't be able to do that. The problem is figuring out. We don't know as much about economics as we thought we did, and equally important, getting the political will to do things that may be controversial but may be really essential. I would like to, I hope, and I actually think, I believe that we will do that. That, although I really think the policy response in the United States has been inadequate, much better than nothing, by the way, and if I can say much better than I would have expected had November gone a little differently, I think it's inadequate. I think we will come back, that we will in fact be able to get a serious bank fix and a serious stimulus package and really do what needs to be done to get out of it. But meanwhile, all I can say is, oh boy, this is, intellectually, it's interesting. Personally, it's terrifying. This is the scariest thing that I ever thought, scarier than anything I ever thought I'd witness in my years as an economist. Thank you.
And speak loudly, I will point. I'll start with this gentleman over here. Paul, what's your impression of the impact of consumer confidence, which apparently just had a small bump up, and I know your colleague on the faculty, Danny Kahneman, studies issues of behavioral.
Consumer confidence has risen sharply. Now, my understanding, you may know better than I do, that there's a weak relationship between how consumers say they feel and what they actually do in terms of spending. So it's somewhat positive. But the thing you want to say is that American consumers were doing virtually no saving. And even now, even with $12 trillion of household wealth destroyed and all of this, savings rates are still below what they were historically before the 1990s. So I think it's a bit much to expect the consumers to do more than possibly slow the rate at which they're cutting back. Maybe a bit more than that, but it's hard to imagine that this is going to be a consumer-led recovery, given the levels of household debt and given the very low levels of saving that people were undertaking before.
Okay, Paul, you are most of the alumni of 94. Very nice to see you right now, since the first time I was introduced to you was through your book, Age of Diminished Expectations. That was assigned to us in the class of Ben. Forgot the name of the professor.
Yes.
Sorry. So in any respect, I have a question that actually arises from the blogosphere. I put a question in my blog telling my readers to say, you have one hour to submit questions for Paul Krugman. The first one was probably the best one. Okay. How will it all end?
That's the question that I've been trying to answer too. I mean, I actually had a post on my own blog called the Eschatology of Lost Decades, the study of last things, right? How does this thing end? And it's not that easy to figure out, although you always want to be careful not to... there's a fallacy of misplaced concreteness that you can have, because you can't be sure how it's going to end, that you don't see it, that you imagine that there's no way it can. If you just look at the components of demand, I would say that you probably have to be looking towards a world economy that, think about that at world level first. World level first, we've got to have less saving by some of the super savers out there. The Chinese have got to save less. The Chinese have got to have more domestic demand. That's one piece of it. The Germans have got to have more domestic demand. On the other hand, we probably have to have more investment, actual business investment in the United States and in other countries that have been low savers. Because we're going to save more, but if we just save more and no one else does it, then it's going to have to be business investment. And the question is, what brings that about? How do we get to that point? And for what it's worth, the little bit we think we understand is that two things will act as long-run cures. One is that debts will go down, that people are saving more, and although a large part of that rise in saving is just depressing the economy and therefore depressing incomes, it does actually translate into a gradual reduction in debt burden and improvements in balance sheets. The other is that stuff wears out, becomes obsolete, and so eventually there becomes a demand for a bunch of business investment even if the economy remains depressed. So this is kind of indicative. Last I looked at current rates of automobile sales, it would take 27 years to replace the automobile fleet. Okay, well that's not going to happen, right? Cars don't last 27 years. So we will in fact begin buying more cars even if there's no increase in the number of cars people want to drive. And that kind of thing put together will lead to a recovery, but it could be very prolonged. We don't have any good role models. As I said, Japan's slump was ended by an export boom, which is not helpful. And the Great Depression was ended by a very large public works program known as World War II, and that's not a very helpful model either. So we don't quite know how this ends. Yeah.
Obviously, you've already touched on this, but if you look at your job production, What would you have done differently, if anything, about the first stimulus package? It seems to me the problem with that package is not producing enough job creation. It's retaining jobs, and regardless of going to service, and you need to do service jobs paid for by public funds to actually make this work. But mostly just retaining, like, let's say, teachers' jobs. But not much job production seems to be involved in the stimulus package, I understand that.
No, the question wasn't the job, stimulus production just job retention as opposed to job creation. Actually, one of the things where it really fell short was not enough job protection. One of the best things you can do for quick impact in this kind of package is to provide aid to state and local governments so they don't have to do these major cuts. And that's, as it happens, the package is replacing only about 40% of the revenue lost by state governments. And it should have done more. Unfortunately, that's precisely the piece that was cut to satisfy basically Susan Collins. So we should have done more of that, but we also should have done more infrastructure. You know, the president made a quite upbeat speech earlier this week about how the projects that are being financed by the stimulus are coming online faster and below cost than expected, which is good news. Actually, the faster is good news. The below cost actually means that we're spending less money, which means less stimulus. But but that also says, I think, that that administration officials were wrong overstated the difficulty of getting stuff moving quickly. So, you know, I talked with people, and they downplayed the amount of infrastructure spending in the bill on the grounds that it would take too long to get moving. So there's a significant amount. There's still almost $200 billion, I think, of infrastructure in there, but they held it down because they said it was too slow. And I thought that they could have done more simply by saying, look, this thing is going to go on for a while. But it also appears that you can move it faster than they thought you could. So that's what it should have been done. More infrastructure, more aid to state and local governments, and a bigger number, you know, 1.3 trillion instead of 800 billion. I guess I'll just do, yeah.
As the economy recovers, the federal government will emerge with greatly swollen debt. And this will probably come at a time when the aging of the population and the Social Security and Medicare programs are also going to be putting a strain on the federal budget. How can all of this be managed, and how big a problem do you see that?
Okay. If everybody get that, federal debt was going to hit the aging of the population, Social Security, Medicare. Okay, first off, about debt. It's not good, but wealthy countries have historically been able to run up to levels of debt as a share of GDP to 100% or more without really being in crisis. So in terms of the ability to finance, you ought to be able to do that. We did that we ourselves did that after World War II. The example I always like to use, though, is Belgium, which had a debt to GDP ratio of about 120% of GDP in the late 90s. And I like Belgium as an example just because Belgium happens to be politically a mess. So the fact that if even Belgium can do that without a crisis, surely we can. But I'd like to think that we could run up from, we come into this with debt of all levels of government of around 60% of GDP. We could, in crisis resolution, run up to 100% of GDP if necessary, which is around $6 trillion. That's not unlimited. That's not a completely blank check, but it gives you substantial running room. Now, there is a longer-term fiscal crisis. It's not primarily about the aging population. That's been misstated. There's a little bit, obviously more Social Security recipients, more Medicare recipients. But if you see those scare charts about how terrible the long-term budget outlook is, it's driven overwhelmingly by healthcare costs. Social Security by itself is a manageable burden. Even Medicare by itself would be a manageable burden if the cost per recipient weren't rising so much, and that's part of the general rise in healthcare costs. So the U.S. long-term fiscal outlook is dire unless we can get healthcare reform that deals with the healthcare costs. But it will be dire. It would be dire even if we didn't run up these debts for stimulus, and it will be manageable even if we do, as long as we get the healthcare reform. So, in a way, the answer to how can we afford all this stimulus is healthcare reform, which sounds a little odd, but it's actually exactly the truth. Yeah.
In light of the global nature of this crisis and the fact that that's so new, do we have the coordination ability to get us out? Can the U.S. lead us out? Or what's the nature of that situation?
Yeah, that's a good question. Coordination, and the short answer is it's a problem. It's not, I don't think it's a crippling problem, but it is a problem. There's a real sense in which each individual country tends to do too little because many of the benefits of its actions spill over to other countries, but the debt that you run up in the course of doing it is all yours, and that does bias us towards inadequate solutions. And we don't have very good mechanisms. We've got the various Gs, G7s, G8s, G20s, whatever, meeting, and they're not completely, high praise, they're not completely useless. Actually, this recent G20 meeting was, as a number of people pointed out, it was infinitely better than the typical international meeting because something was accomplished, whereas normally nothing is accomplished. And if you divide by zero, it's infinite. And it was actually fairly serious. There was a substantial increase in resources for the International Monetary Fund to help smaller countries in crisis. So I think that was a serious thing. But we really ought to be having, we ought to be having a coordinated global bank rescue. We ought to be having a coordinated global fiscal expansion. We're not getting any of that, and no real prospect. Again, if we think of the Great Depression, in the end, recovery occurred, among other things, after protectionism and exchange controls had fragmented the world economy so much that you could have purely national solutions. We hope we don't have to go down that route. But yeah, we're having a problem. And, one more thing to say. The coordination problems are much greater if you just look within Europe. It's not the grand global cooperation thing is one thing, but the cooperation, coordination stuff within Europe is even more urgent because they're so tightly linked. And that's been another one of the shocks of this crisis, how badly the Europeans are falling down. Their inability to act as a unit in the face of an economic crisis is one of the major disappointments of this whole story. Wow, go way back.
Is there something different about the kind of unemployment we're seeing starting to emerge? You read these articles about Watkins doing layoffs, and it's sort of hard to imagine what all these attorneys are going to actually be able to do.
Yeah. My understanding, again, I suspect that people here know more than I do. What I understood was that the unemployment this time around is more normal than it was in the last recession. 2001 recession really did hit highly educated, high-tech workers especially hard because of the bursting of the tech bubble. And while this one, it's true that it's affecting the financial industry, which is not what you normally expect. It's also hitting manufacturing brutally. And so actually it is, a lot of the increase in unemployment is the normal thing. I think the stories of lawyers and investment bankers without jobs, they get a lot of press, but they're not most of the story. Which isn't to say unemployment is a terrible thing to whoever it happens, and I've got friends and relatives to whom it has happened. But the biggest damage is actually coming. Manhattan is not a happy place right now, but Detroit is even unhappier than Manhattan. I think you want to bear that in mind. We have that here.
Hi, could you discuss the role of technological change in your thinking, particularly as a source of productivity improvement, which would drive economic growth, and a source of demand for new consumer purchases?
Yeah, technology. And technology raises the economy's long-run capacity, which is good, but only if you use that capacity. So that's not much, doesn't have that much bearing on this. What it does do is it creates demand for new stuff. So even if, well, you can look at capacity utilization in U.S. industry is at its lowest level since the 30s. Why would any business want to invest in new machinery? Well, the answer is if the machinery does something you couldn't do before, they still will. So if you can get really dramatic technological change, that's one source of a boom. You could argue, actually, we had first brush with a really intractable recession in 1990-91. And there was a lot of concern that we were really getting stuck. And then we had a really vigorous recovery through the 90s, and what that was driven by was, above all, information technology, leading to a lot of investment, which of course then got overdone, and then we had another bubble, and unfortunately we got, our response to that one was not another wave of innovation, well, actually it was a wave of financial innovation, which has become a dirty word. But yeah, the technology helps, and that is a part of what in the long run means that regardless of how badly we screw this up, we will eventually recover. But it might take a while. The ways that something could really, these things could turn out much better than I expect would be if we really do have a radical set of technologies that spur a lot of investment. If we could come up with something really good, if somebody come up with extremely cost-competitive green technologies that led us to overhaul a lot of our power infrastructure, say. That would be perfect right now. If anybody's got an idea, let us know. Alternatively, we can have the best analysis still I've seen of the economic outlook was from America's finest news source, which is The Onion, of course. And last summer, they had the headline, "Recession-Plagued Nation Demands New Bubble to Invest in." Let's try over. Yeah.
I'm glad to hear your humility about our ability to understand the economic system through modeling. I worked for many years in weather modeling, and of course that's led to the current wave of worry about global warming. I debugged some of the programs for some of the leading advocates of that, and I would say I'm somewhat skeptical about how much we know about weather modeling. What they're demanding is that we get rid of devices that are creating carbon dioxide. Now that seems to me to cost about $1,000 what this stimulus does. So where do you see the impact of global warming concerns on the economy?
As the only part on which I have actually I have no part on which I have an independent judgment, although I find the global warming, the climate change stuff pretty convincing while I'm aware that the precision is not high. But in terms of the economics, there have been a number of attempts to estimate what the costs of fairly stiff carbon dioxide reduction regimes would be. And my understanding is that if you're taking a long view, it's not that hard. That if you insist on doing it in 1 year, then it's very hard because you've got what you've got. But if you try and do it over a long term, there are many, many margins of substitution. You can have more fuel-efficient vehicles, you can have alternative fuels, you can do lots and lots of things, and that drastic reductions in CO2 from the baseline still would at most reduce GDP 30 years out by a couple of percentage points, which is, is a rounding error on the annual growth rate. So I think it's not that bad. Now, to do it right now, it's actually, in effect, cap and trade is a tax. And that would amount to raising taxes in the middle of a recession, which is probably not something you want to do. But it's not going to happen that fast anyway. And I don't think that's an issue. And of course, new regulations requiring that people do more fuel-efficient stuff or whatever, if we could do it, could actually spur that wave of investment that we want. There's a funny thing in there that you could actually have some good stuff. So no, I mean, I don't think there's a whole lot of interaction between the climate change issues and the current slump. I'm going to try.
A lot of seniors have been surviving on Social Security and money market interest. With the money market interest now down to zilch, many of them may be forced to go on welfare. What do you think about issuing senior savings bonds with subsidized interest to keep them off welfare, keep them spending?
I would do that. One proposal for ways in which you could do some additional stimulus would be actually a Social Security bonus, to actually add to the Social Security checks, which would have the same effect, except it would be, the distribution would be somewhat different. But that I think makes sense. But the idea I think that's going a little too far to say we need to compensate people for movements in the market rate of interest. So, I'll try right this center. Second back there. Yeah. Okay. What do we know about banks? About bank rescues is the question. We have we have a few role models out there, which all amount pretty much to a two-step. First, you guarantee the liabilities of the banks, or at least most of them, so that you don't have a crisis of confidence that deprives them of funding. But secondly, having, as part of that, you go to banks that are actually insolvent, and you take them over, pay off some of their debts, and resell them into the private market. So you recapitalize them. So it's a combination of guarantees and receivership, temporary nationalization. And role models for that, well, actually we do that to about 2 banks a week in the United States. But they're ordinary banks. They're small regional banks. And every week these days, the FDIC, which of course guarantees the deposits, that's the guarantee part, seizes insolvent banks. And that's a normal thing, and that works. And for doing it for a whole banking system, role models are, well, everyone talks about the Swedish solution, and Sweden did more or less, did exactly that, seized a good part of its banking system after first guaranteeing the entire system's liabilities. So that would, and Japan is more complicated, but in a blurry sort of way, that ends up being kind of what Japan did in the end to its banks. So that would be the normal roadmap for cleaning up your banking system. We're not doing that, at least right now. We're not doing it for a couple of reasons. Some foolish, some not so. Some have some force. The foolish stuff is people say, "Oh, we can't do Sweden because Sweden had just 5 banks and we've got 8,000." But the truth is that we've got, most of those 8,000 are small, and in fact, the FDIC can handle them. And if you actually look at who's got the assets in the banking system, most of it is, in fact, just 4 banks. And even these stress tests are going after 19 institutions. So if we can resolve those 19 institutions, that's it. So that's not a good argument. There is an argument about legal authority. The FDIC has the ability to seize a depository institution, but something like Citigroup is not. There is a depository institution in there, but there's a whole lot of other stuff. It's a bank holding company. Not entirely clear under what authority you do a seizure. It's also not entirely clear under what authority you guarantee their liabilities. So you would, in terms of the seizing, I think you can probably find a way to do that. You basically make them an offer they can't refuse for a tender offer for their stock. But the liabilities, you probably need congressional authorization. So it's not quite as easy as that. But it could be done, provided, and then I think another sticking point is you do need Congress to be prepared to put a lot of taxpayer funds on the line as guarantees, which Congress certainly is in no mood to do, although it's a question, has the administration even really tried to sell that? And of course they haven't. So it's all kind of difficult, but, no one, it's not supposed to be easy, I guess is the point. But that's the way I think it will go. And, my prediction is that in the end, that's what will happen. Though I'm not sure of that. I mean, what you hear right now, okay, the buzz is that the Federal Reserve and also the administration are talking a lot about what happened in the 1980s. And if you went back to the early 1980s, several major U.S. banks were probably insolvent if you forced them to mark to market, largely because of bad loans to Latin America. But they basically papered that over. They managed to avoid an outright default by any of the Latin countries. They managed to make the whole thing sort of hang together. And it all worked out in the end, because we had a nice vigorous recovery in the United States, which let them get good profits, and the Latin Americans in the end did a better job of paying their debts than many people feared they would. And so people look at the 80s and say, well, why can't we just do that again? Which is, of course, happens to be also what the Japanese tried to do, which was to just sort of paper it over and hope it. But right now, the mood in Washington is that, well, we can just get ahead and we can finesse this. And they might be right. Stuff happens. Sometimes things turn the right way. But if not, then I think what happens, and I wouldn't be surprised if it happens sometime this year, is they say, whoops, and we're really in trouble here, and go back to Congress for the authorization they need, and after much yelling and screaming, get it, and then we actually do a Swedish model in the United States.
Paul, one more question.
Someone up there, I'm not precise enough, so, all right, I'll go for right. Sorry.
Jacqueline Harrington, class of 84, I'm with American Red Cross. You've commented upon individual savings rate and the uptick recently, but as well as continuing consumer debt. Does your research at all touch on any trends or changes in individual philanthropic giving in light of the economic downturn?
Okay, the answer is I know nothing about it. I wish I did, but I know nothing. So we'll take the other question because I'm hopeless.
Now that you've assured us that this will come to an end, what things do we need to do so that it won't happen again?
Okay. That I have thought about. Yeah. Well, I actually wrote about it in the Times. There are many factors in that made this possible, but surely, if there's one single thing, it is the fact that the banking system got just too exciting. Basically, we did not have anything like the Great Depression for 50 plus years after the Great Depression. And I believe, and there's a lot of reason to think this is true, that it was largely because the banking system had been heavily regulated, had been severely circumscribed. It meant probably that some worthy borrowers weren't actually able to get loans, but it meant that there were not a lot of risks being taken. And banking was really boring. And you can see that. Bankers did not get paid exceptionally high incomes. The whole system was kind of banking was a low-risk, low-interest venture, and pretty safe, not just for the banks, but for the economy as a whole. And then we got sold on the idea that, well, we need to let the dynamism of the market in, and we need to let banks do more stuff. We need to let banks compete. I'm old enough to remember when banks competed for depositors by offering toasters, and but instead they started competing by offering all kinds of high interest rates and fancy arrangements, and they began not holding on to their loans, slicing and dicing and selling them off, and the whole system became extremely yielded huge profits. I mean, at its peak there a few years ago, the financial system was 40% of profits in the U.S. economy. which is, if you think about it, basically crazy, right? I mean, this is not if this is helping move money to where it's needed, hopefully, but it shouldn't be that huge, but it became a huge thing. So what we need is to go back to that a boring, circumscribed banking system. We want a situation where the best and brightest, or anyway, the brightest of our Princeton students don't think that Wall Street is where they ought to go. And that's, are we ready to do that? That's going to be interesting. Okay.